Three stocks could surge over 60%. Investors are facing a confusing environment with long and short-term signals sending different messages. Inflation remains stubbornly high, above an 8% annualized rate, and the Federal Reserve has made it clear that additional interest rate hikes are in the offing. Stocks are well off their highs, and despite last Friday's gains, the S&P 500 and the Nasdaq posted their sixth consecutive weekly loss. But there are positives too. The first quarter 2022 earnings season gave an upbeat vibe as more than 3/4 of the S&P listed companies reported positive earnings surprises. However, while corporate earnings are up 4 now, the Purchasing Managers Index PMI, a measure of inflation from the production side, is running at 11%, suggesting a higher rate of consumer inflation later in the year. So how do you find the next hot stock to buy in this environment? One way might be to screen for stocks that have been endorsed by analysts at major investment banks, in particular such as Wall Street banking giant Morgan Stanley. The first stocks analysts are showing their upbeat outlook by selecting the stocks they see as winners for the coming year, and winners with a substantial upside on the order of 60% or better. Using the T Ranks database, we've looked up 3 of the Morgan Stanley picks to see what makes them stand out. SI-BONE Inc., SIBN. We're starting in the healthcare industry with SI-BONE, a medical tech and device company. SI-BONE works in the field of sacroiliac joint pain and diagnosis, or in the layman's language, treatment of lower back problems where the spine connects to the pelvis. Musculoskeletal disorder of the sacropelvic region have a large impact on quality of life, and SI-BONE's mission is to develop new surgical devices and procedures to solve these issues. The company's lead product is the iFuse surgical implant system. This orthopedic implant device is designed for surgical procedures featuring small incisions and faster recovery times, and its triangular shape is proven to produce a more effective result in the patient's recovery. SI-BONE saw significant pressure early in the year when medical procedure deferment generally peaked. SI-BONE's total deferment in January and February reached approximately 140, but there were fewer than 20 in the month of March, indicating an acceleration of business. The company's worldwide revenue grew 22% in the first quarter to reach $20.4 million. This number included a gross profit of $18.2 million for a gross margin of 89%. This compared favorably to the $16.8 million in revenue and $14.8 million profit from the same quarter last year. EPS, however, came in negative. The net loss of 30 cents per share was an improvement, however, over the 47 cents EPS loss in the year-ago quarter. SI-BONE finished the first quarter with cash and short-term liquid assets, including inventory of $208 million. Morgan Stanley analyst Drew Ranieri has a positive outlook for SI-BONE's immediate future, writing, "While first quarter was in line with our expectations, the recovery trend exiting the quarter remains promising for the balance of 2022, and we'll see a positive setup for upside through the balance of the year if the pandemic procedure pressures continue to abate. Broadly, our commercial inflection point thesis remains intact, and we believe this should become more visible as procedure recovery takes further hold through 2022. To this end, Ranieri rates SIBN shares on overweight, that is, buy, and his $22 price target implies a one-year upside of 76% for the year ahead. Overall, there are 5 additional analyst reviews on this meditech firm, and they all agree with Morgan Stanley's bullish takes for a unanimous strong buy consensus rating. The shares are selling for $12.50, and their $27.50 average price target indicates room for a 120% one-year upside potential. Palo Alto Networks, PANW. The next stocks on the Morgan Stanley's radar is Palo Alto Networks, a leader in the digital world security segment. The company offers its customers protection from malware attacks through state-of-the-art network firewall technology. Palo Alto's product lines allow customers to automate their online and network security operations to secure cloud activities and applications, and even to home and small business networks with enterprise-grade security. Given the increasing importance of online security, both generally and specifically in today's work environment of increased remote and home office activity, it should come as no surprise that Palo Alto's revenues and earnings are both up. At the top line, the company has seen increase in revenue numbers for the last 2 years. The most recent report for the fiscal second quarter 2022 showed 30% year-over-year revenue growth to $1.3 billion. Non-GAAP diluted EPS was reported at $1.74 for the quarter, up 12% year-over-year. Looking ahead to the full fiscal year 2022, the company expects its total billings to reach between $6.8 billion and $6.85 billion. This would represent a year-over-year gain of 25% to 26% and would support revenues in the range of $5.425 billion to $5.475 billion. For For comparison, the top line in fiscal 2021 came to $4.256 billion. All of this adds up, in the view of Morgan Stanley's Hamza Fodawala, to a solid prospect for investors. Fodawala writes of PANW, security remains a top priority due to rising cyber threats and is by far the most defensive area of spending within IT budgets, with Palo Alto's network positioned as a top strategic vendor to capture more wallet share within a large installed base of nearly 60,000 customers. With durable top-line growth, plus a focus now on driving higher margin and capital returns, we view PANW as one of the most attractive risk-reward opportunities in software. In line with this bullish comments, Fodawala rates PANW an overweight, that is buy, and sets a price target of $823 to suggest an upside potential of approximately 6 to 8% going forward into next year. This view is far from the only bullish take on Palo Alto's network. The stock has no fewer than 23 buy rating on record, overwhelming the two holds for a strong buy consensus view. The shares are selling for $491.01, and their average target of $656.88 implies an upside of approximately 34% from that level. ZoomInfo Technologies, ZI. We'll wrap up with another tech firm, ZoomInfo. This company offers a range of B2B services through a cloud-based platform that includes sales and marketing, prospect, demand generation, account management, data management, and custom data solutions. The company's platform gives both marketers and sellers the tools they need for a comprehensive view of their business landscape to shorten sales cycles and increase win rates. ZoomInfo already holds a strong position in its niche, but that has not prevented it from taking steps to expand its footprint. Earlier this month, ZoomInfo announced that it had acquired a digital marketing and branding platform Comparably, combining that company's platform with ZoomInfo's existing Talent OS. ZoomInfo did not disclose financial terms of the acquisition, which is expected to show a positive impact on the firm's full year 2022 result. On the same day as the Comparably announcement, ZoomInfo released its result for the first quarter of 2022. The company posted revenue of $241.7 million, up an impressive 58% year over year, and 18 cents per share in non-GAAP diluted earnings. That EPS result was flat sequentially, but up 38% from the year-ago quarter. The company had $125.9 million in unlevered free cash flow during the quarter. ZoomInfo expects revenue for this calendar year to reach $1.06 billion to $1.07 billion, an increase from the previous guidance of $1.01 billion to $1.02 billion. Management expects this revenue to generate between $435 million and $445 million in unlevered free cash flow for the year. Five-star analyst Keith Weiss covered the stocks for Morgan Stanley, writes of the company's outlook. We believe a higher level of investment to build out the platform capabilities is warranted in light of sustained momentum and large market opportunity. We see ZI as one of our top ideas into 2022 as the company continues to deliver near 50% organic growth, supplemented with best-in-class profitability. Acknowledging the company's potential growth, Weiss rates ZI shares an overweight, that is i.e. buy, and his $81 price target suggests an upside of approximately 84% for the year ahead. Wall Street tech firm typically pick up a lot of analyst attention, and ZoomInfo has 14 recent reviews. This includes 13 buys and a single hold for a strong buy consensus rating. The shares have an average price target of $71.08, suggesting an approximate 61% upside from the current trading price of $44.03.